Should retirees lock in these relatively high fixed rates that are happening right now? It's July of 2023. Short-term rates, fixed rates in the banks, insurance companies are relatively high. It's highest that I've seen in maybe 20 years. Why not lock it in? Are you locking it in? Are you retiree thinking about it? Let's bring in my trusty sidekick, Tony Shore. Tony, we did a show 2 years ago. I looked. I'll put it up here for those that are watching on YouTube. 2 years ago, you were quoted. I was going to actually video clip it, but
oh no, what did I say?
You were quoted as saying what short-term rates were, and I wrote it down. So at that time, you said you could get a high-yield savings rate in July of 2021 for 0.5%, or you can get a one-year CD at 0.7%, or a two-year CD at 0.75%.
Yikes.
How far have we come in 2 years? So we're talking
why? What are the
rates
rates now?
We got CDs, certificates of deposit, banks, wherever. We got MYGAs, multi-year guarantee annuities, T-bills, treasury bills, money market funds, high-yield savings account. So you can get a high-yield savings account right now, 4% or higher. You could get money markets, 4% or higher. You could get a T-bill. Treasury T-bills are from 1 day to 1 year. That's the range of the length. Those are over 5% right now. You could get
my aunt got a MYGA for 5%. I think at least 5%.
MYGAs, okay, multi-year guarantee annuities. These are fixed annuities,
5%.
Different than CDs. You can get 5%, over 5% right now for 3 years, 4 years, 10 years. If you really wanted to go that far, you can get a 7, 8, 10-year MYGA and lock in above 5%.
That's amazing.
CDs offering over 5%. They've come down recently.
Haven't seen this in forever, right? I mean, over 20 years.
Yeah, I remember doing it in the early 2000s, I think.
Oh, really?
I remember getting a high yield savings account over 5, maybe 6.
Really?
Okay. Maybe even 8. I don't remember.
But it's over 20 years ago.
Yeah, it's been a while, right? And I've had people over the years that I've been doing financial planning, retirement planning, come to me and say, "Here's my money. Get me a good return." And what's good return? Well, anything better than the bank. Well, now banks are offering decent returns.
Yeah.
And I think people might be crazy not to capitalize on this.
Yeah.
Especially if you're sitting on cash at the bank making 0.2, which is what it's been doing for the past. I mean, just think about it. 2 years ago, at that time, when a 2-year CD is paying 0.75, you and I were like, well, it's better than cash at the bank, better than its savings checking, right?
Mm-hmm.
A lot has happened since.
Yeah, it has. It has. I mean, so yeah, I mean, if I'm a retiree, why then wouldn't I want to put all my money into a CD or a MYGA? Why wouldn't I want to take all my savings or my retirement money, cash out my 401k, my IRA, and if I can lock in 5% or 6% for 10 years, why wouldn't somebody do that?
Well, that's an interesting question. I remember very vividly, this would probably be 2010 or 2011, but I remember a conversation I had with somebody who had a lot of money, millions, and said, "You give me 5%, I'll give you everything. Give me 5% guaranteed and take it all." And of course, at that time, I couldn't. I said, well, we can go fixed rates are here, less than 2, and maybe I can get you 3. We can maybe go for 4, but we can go dividends. We can go in the stock market and do a bond portfolio, so on and so forth. But I couldn't get a guaranteed 5%. And now that same person could say to me, like you're saying, why wouldn't I put all my money? If you can give me 5%, take it all, right? It's a really good question. Now, of course, you don't want to put all your eggs in one basket. So that's number one. But it's a really legitimate question, Tony.
Mhm.
Why not? Why not? Why aren't people just jumping on these? It's a good question. Well, let's talk about a few of the considerations here. The first and most obvious is liquidity. So,
Yeah, if you have to
I don't want to
lock
lock
in
up
for
my
10
money.
years.
Right,
Yeah.
right. But think about the people. Well, think about 2 years ago, we were saying 2-year CD. So say someone bought a 2-year CD at 0.75, and now here we are that's matured. Odds are they probably pulled out of it sooner than that, because the penalties are, you can get something much better and make up the penalties in a couple of months. But now they're sitting, okay, I just got 0.75 for 2 years. I can get 5.75 for 5 years or whatever. Let me do this. Liquidity is the big factor for a lot of people. So why wouldn't you put all your money and lock it in at 6% or 5.5% for 10 years? Because you might need that money prior to, and there's penalties to leave CDs, penalties to leave multi-year guarantee annuities. You can't lock in 5% for 3 years with a T-bill. Like I said, it only goes up to a year. The money markets, the high yield savings that people are getting right now, you can't lock. Those aren't guaranteed to sit on that same rate for that length of time. A CD, the CD rates have come down since the last couple of months. So if you want a 5-year CD, you can't get a 3-year 5-year CD. You might get a 1 year. You might get a 6 month. And then what?
Yeah. My dad, when the interest rates started going up, and my grandpa Bob, who was 101, passed away it's been about 10 months that happened, or almost a year now. And 10 months. And then so my dad got a check that was a portion of the CDs, and my grandpa had all CDs. Unfortunately, my grandpa at one point had a lot of money, but being of that older generation, he thought stock market's risky. I want safety. And he had all his money. Well, most of it was tied up in farmland. So he did have a lot of real estate. That's the positive thing. That's the growth, I guess. So I guess he did have growth. I was going to say he had no growth, but he had nothing in the stock market. He had no portfolios. He just put all his extra money in CDs.
Well, considering he was alive and well during the Great Depression, he's seen that. He's seen several depressions.
Yeah.
You're right. So but was that bad? Was having all of his money in CDs bad for your grandfather?
It was bad for his inheritance, or his kids, because that money could have, if you look at the period he had them in the CDs, and that was that low interest to no interest period, especially the end there, the last 20 years, right? If that last 20 years of his life, he had it in the stock market, the kids would have ended up with, my dad would have ended up with exponentially more. But then my dad got this check, and my dad he might need it, so he can't put it in anything long-term. And my dad also is adverse to risk. So he put it in a CD, and the interest rates are higher, and he got 3.7 or 3 something out of a CD. But the longest term he could get was 17 months.
Right.
Because the
CD,
weird,
right? 17 months.
The bank. I know. It was,
but they do that. It's gimmicky.
Yeah.
But it's all based on their projections and their balance sheet. And
because they're worried about the interest rates going back down. The banks know. So they're not going to do a 10-year. They're not going to give you a 5-year CD and lock in 5%, because they know within a year, the rates could be back down to 2 or 3.
Right. And so right. So the time horizon is interesting, and the banks are lowering rates now. So why not lock it in like your grandfather did? Of course, inflation is going to eat you alive. But then again, what did inflation do to people investing in the market? Last year, 2022, instead of losing 20%, they lost 27% due to inflation.
And when inflation was at its highest, the market was at its lowest it had been in a few years.
Right.
So they got killed too.
I agree that the inflation is a factor, right? You can't just put all your money in a CD and expect to outpace inflation. Yet it's not the end. It's not bad for this thought process. So going back to your grandfather, was it bad for him to put all his money in CDs? No. Was it bad for his those that are waiting on that inheritance? Well, no one was waiting on the inheritance for him. But
no.
Yes, in terms of, could it been much higher had he taken more risk? Yes. Would your grandfather's state of mind been different? Would his retirement have been the same had he been in the risk? Would he have panicked in COVID times and oh my God, I'm sell at the bottom and really lose years and years of interest that he would have gained?
He would not have had the peace of mind. It would not have been. The answer to your question is no. My grandfather would not have been happier. And it wouldn't have been better for him personally because he didn't worry about his money. He knew where it was and what he was getting.
Right.
So, and that's what he wanted. And
he had his time horizon. Well, for him, did he expect to live to 101? Maybe not. But yeah. So yeah.
No, he didn't. He expected to live to 120.
Well, there you go. So
I'm not even kidding you. He expected to live a long time.
So buying CDs may not be the smartest thing for him.
Right.
But for those that have a shorter time horizon, and this is where laddering comes in. A lot of people hear this is like, well, why not buy a 5-year fixed annuity and a 1-year CD and a 2-year CD and ladder these things so you get the money as it comes? That is not a bad strategy.
Right.
And why not put a bunch in T-bills for a year while you sit and see what happens? Sure. Now, for the long term, yeah, maybe the stock's the way to go, but I don't like this shaming of people being afraid of the market and going into fixed rates. Oh, you're going to get eaten by inflation. Well, yeah, but so are you. Well, aren't we all? It's more about,
well, in 2022, the stock market was a much worse option, obviously.
How many years is
inflation went up while the stock market goes down, so that gap that you lost is really big.
And bonds, right? So I can get a 7% bond, and that's what I'm hoping for. And on average, the bond's going to yield me 5% after fees. Well, I can get that at a CD or a fixed annuity. Why would I mess with the bond? Why would I take the risk? Is a very legitimate question. Now, of course, everyone's situation is different, but liquidity is a big factor. Okay, if you need the money in 18 months, then buying a 3-year MYGA, multi-year guarantee annuity, makes no sense because you're going to get hit so hard with the penalties. It makes no sense. Right. But if you need the money in 3 years, maybe buying a 2-year CD or a 3-year CD makes sense because I'm not going to need that. As long as you have some liquidity in other places. Taxes is another thing, Tony. I was having this conversation with a client, and he asked me, why would I not put more into the 5-year or the 5% right now? And I said, well, we're getting municipal bonds. He's in New York, so he's paying state tax, which municipal bonds you don't pay tax on. And so the after-tax yield for him was much higher. So taxes sometimes factor into whether or not you want to lock in. MYGAs, multi-year guarantee annuities, are tax deferred. So you don't pay tax until you actually take the money out. Whereas a CD, you pay tax right away. Money markets and money markets, high yield savings are very liquid, but you're paying tax on it. I think taxes are a factor for people with the higher tax brackets.
Sure.
But penalties also linked to time horizons and liquidity. You got to be careful with these because you might buy a CD and say, "Oh, I'm going to get a 2-year CD," but you forego interest. 6 months or a year of interest, or a multi-year guarantee annuity you might be getting 5%, but if you leave it early, it's a 7% surrender charge. Whoa. So I can actually lose money by yes. So this penalties, timing, this whole idea of, hey, why don't I take all my money and put it in a 5% fixed makes total sense to me. The logic makes sense to me. You just need to worry about liquidity, penalties, taxes, and when you need the money. But if someone said to me, hey, I won't need this money for 10 years, Why don't I take 5.5% guaranteed for 10 years, compounding, as opposed to riding them stock market wave? And that is a very good question that there is no right answer to. But if someone said to you 10 years ago, hey, I'm going to put you in a stock market portfolio and we're going to average net of everything 5%, would you be okay with that? And I think most people would say yes. What would you say?
I would say yes.
It's reasonable.
Yeah.
But then I would say, if you're going to put your money in the stock market, you should expect more than you can get at the fixed rate. So anyone putting money in the market now should not be putting the money into the stock market now with the expectation they're going to get 5%, because that doesn't make sense. If you're going to put money in the stock market, you got to be willing, you got to be expecting a higher than 5% return. Otherwise, why not just put it in?
Sure.
So,
except it depends on your situation, how much you have, your time horizon, like you said, and it depends on, and again, as a financial advisor and a fiduciary, you're not ever going to recommend somebody put all their eggs in one basket.
No, but
if there's a run on the banks or something, there's a black swan event, you don't want all your eggs in one basket.
You have to look at FDIC insurance for the CDs. You have to look at the state guarantee fund for the annuities. They're not the same. Banks and insurance companies are not backed the same way. So you have to be aware of this. But if someone comes to me with $1 million and says, I need to generate $50,000 of income a year, I'm hard pressed to say, let's go in the market for all of it. Yeah. Why? They could buy a 1-year CD, make 5%. There, no risk. They got it. There's some risk. I can't say no risk, but $1 million, you'd want to spread that out into multiple banks to stay underneath the FDIC limit. But
a 250 or whatever it is.
It makes sense. It makes sense. You can get this. So I think that fixed rates are very powerful. You could use it to create income. I see a lot more people doing that now. You're reducing portfolio volatility. So why not take a portion and get some of these fixed rates while the getting's good? And for retirees, it's a very different conversation than for people in their 40s. Keep in mind, if you buy a multi-year guarantee annuity and you take the money out prior to 59.5, there's an additional penalty. So annuities, the fixed annuities aren't necessarily good for people that are younger than 60. They can work, but there's another little tidbit there that most people forget about. But it makes sense for the retirees right now to look at these fixed rates. And a lot of people are jumping on it, but if you have money sitting on the sideline and it's not making 4 or 5%, that doesn't make sense to me.
Right. Yeah.
That's the bottom line. But Tony, I think more and more, I don't know. A lot of financial advisors get paid to have money in the market, so they don't like these fixed things,
right?
Of course, away from their revenue source. For me, I look at it as this is a great opportunity, and I believe that retirees in particular should be looking at these fixed rates that are offering right now and capitalizing as much as possible, because I do think they're going to come down. I don't know. I don't have a crystal ball, but if you think about the U.S. debt, we owe how many trillions? If the Fed allows these rates to go up and up, who's going to pay the interest on that? They can't. That's not sustainable. We'll go bankrupt. No. So they're going to have to lower these rates just to be able to make the country stay afloat. So guaranteed 5% for 3 years, I don't know if it's here to stay. So if you lock it in now, will you be kicking yourself if it goes up to 6% or 7%? Yeah. But will you be kicking yourself if it goes back down to 3%, 2%? Yeah. You'll be, think about the people that bought 10% CDs back in the day. And then when they came due, there was a tear coming down. Oh, I have to give up my 10% CD,
Yeah, exactly.
So, by the way, Tony, I know you asked me before the show and you told me not to, say it out loud, but Tony asked, should I get a mortgage on my house and take all of that and buy a CD and arbitrage? And I said, no, we don't want debt, right? So getting debt to leverage, if you have some debt already that's low, maybe you don't pay it off and you invest in them, but another story for another day. So Tony, 2 years from now, what's your prediction? Because I held you to it. 2 years ago, It was less than 1% for a 2-year CD. Right now, you can get 5. What do you think it's going to be 2 years from now?
Or 1 or 2.
Ooh, you think the rates are going to go down that quick? 2 years from now?
2 years? Well, yeah, I think we'll be back down to the 2% in 2 years.
Okay. All right. We'll catch up in 2 years from now, and we'll test you, and I'll buy you a
I know
cookie
you'll
if you
hold
want.
me to it. Yeah, yeah.
All right. Well, thanks for a good show. Have a great week, everyone. We'll catch you next time.
All matters discussed in today's show are for informational purposes only.
This show is not investment advice.
Dan Riddle nor Dolphin Financial Group are affiliated or endorsed by any government agency.
Investment advisory services are offered through Dolphin Wealth Management, Inc., a registered investment advisor in the state of Florida.
Insurance products and services are offered through Dolphin Insurance, Inc.
Dolphin Wealth Management, Inc. and Dolphin Insurance, Inc. are affiliated companies doing businesses as Dolphin Financial Group.
You should talk to someone at Dolphin Financial Group before implementing any of these strategies or ideas.